Yes, if you can do it.
Okay, so if whatever you want to talk about in the overtime session, just put it into the chat and we go in order. So Clyde is first with mutual funds. So the first thing I would tell you, Clyde, is you got to be careful when they say a sale of a mutual fund, because if it's open end, it's going to be a redemption, not really a sale. And it's going to be based on the next calculation of the NAV. Very technical, that's called forward pricing. Whereas if it's a closed end fund, it's going to be done at whatever the market price is. Because remember, closed end funds trade in the secondary market, supply and demand. Now, in terms of taxation, I'm not sure. Well, what do you mean from the advisor to the client? It depends on what kind of advisor you are. So, Clyde, if I'm a 663.65, or I'm a 763.65, or I'm a 766, and I say, listen, as your investment professional, I think you need a mutual fund. Mutual funds are pretty cool. They give you professional management, diversification, and ease of ownership. And you say, Dean, do you know where I can get a mutual fund? I say, I certainly do. You know, my broker dealer has many mutual funds on the approved product list, and I'd be more than happy to get you involved in that. Now, again, there's a load on that. So it's either going to be an A share or B share or C share. So I would say, Clyde, it depends on what kind of a context are you selling this mutual fund. So I thought you meant selling like redemption. It sounds like what you mean is I'm going to get somebody involved in a mutual fund. And there's two versions of this. There's a no load test question. I can have a promotional expense of 12B1 fee of 1/4 of 1% or lower and still refer to myself as a no load fund. Or there's a load. Now, the test primarily assumes, Clyde, that I'm selling you a loaded fund, an A share. And so, you know, maybe it's a 4% load on the A share. And then the test really gets into letter of intents, which are for quantity discounts, which can be backdated 90 days. So all that stuff is pretty testable. Is that what you're asking, Clyde? You actually have audio and video here, so you can actually unmute and then ask me what, if I'm not understanding you correctly, what it is you're asking.
A sale of like when I'm suggesting a mutual fund to a client. Yes, that's what I'm talking about.
Okay, cool. So just remember, the big thing is sunlight is the best disinfectant. And so disclose, right? So, we always disclose that relationship. And then I said, we always disclose that conflict of being an agent of the broker dealer, as well as being an investment advisor rep, which I think most of you are going to be doing, right? So I say, listen, I represent both Merrill Lynch and I represent you and I represent myself. And so, all that. Communication is pretty straightforward, Erica, for test purposes. You have retail communications that go to more than 25 persons in a 30-day period. And if it's a retail communication, it has to be approved pre-distribution by a principal, and it has to be filed with FINRA, either 10 days prior to first use if you're a first-year firm, or 10 days after first use if you're a established firm. If it's correspondence, 25 or less, the principal can approve it, or the supervisor, because it could be 910, has to approve it pre or post distribution, their choice about whether they want to do it pre or post. Hedging is offsetting risk or risk mitigation strategy. And in risk mitigation strategies, we're going to have a stock position. And so we are going to have either a long stock position or we're going to have a short stock position. So those are two places where we'd be interested in doing risk mitigation. I would tell you it's really more important, Erica, to be able to do risk mitigation on a short stock position, because Erica, test question, don't be a dumb bear. If you short the stock and you don't do risk mitigation, you're going to end up having unlimited risk. So in terms of hedging with options, if we're trying to protect either a long stock or short stock position, we know that we're going to buy or go long the option contract. So the minute you hear protection, you have a 50-50 chance on the test. because you know you're buying. You can eliminate the choice that says we're going to write, because that's not what we're going to do. Protection costs money. I think of it as buying insurance. If you want to buy insurance, you don't buy insurance because you're going to wreck. You buy insurance because in case you do. You know, Erica, got in a little accident and I got out. And the first thing I said to the guy is, I'm properly insured. This is not a problem. It is not a problem. Are you okay? He goes, yeah, I'm okay. I said, well, cool. Who cares about the cars? We can fix the cars. Get new cars. It's not a big deal. Right. So I pay my insurance company a premium. They say, Dean, something happens, let us know. We'll take care of it for you. So I'm going to go long, and I can either go long or buy or go long. It's like learning a foreign language, a call, or I can buy or go long a put. So you have a 50-50 here. Let's just label this. Let's label this as my answer set, and we'll call this choice A, and we'll call this choice B. Well, let's make it C. Let's say there was something in between there. There was a B choice and a D choice. Okay, so chat is open. Chat is open. Erica says that she would say that the proper way to hedge the long stock position is to buy a protective put, to marry a put to the stock position, and she is correct. She is correct. That's a pretty smart thing to do, because now, Erica, you put in a floor. You put in a floor. You've done construction. So, for example, Apple today is 162. Let me check the price of Apple. AAPL. 165. Wow, high beta. And so maybe, Erica, I buy the Apple at 165. And if that's all I did, it could go to 0. But if I buy the 160 put at 3, now anytime I want, I can sell the Apple at 160. So 168 is 160 is my exposure. I have the ability to participate in a big price increase, but not participate in a big price decrease. What is another risk mitigation strategy we could use? What's another risk mitigation strategy we could use for a long stock position? We could use a sell stop. So a sell stop is another way to protect that stock position. You know, the advantage of the sell stop is I don't have to be approved for options. I can move it around, and, you know, I don't have to pay a premium. The disadvantage to the sell stop is I don't have guaranteed execution of the strike price. Whereas with that protected put, I paid a premium and I have the choice. I can sell at what exercise and sell at that price. Short stock, kind of cool, because as that short stock position sits right now, it has unlimited risk. And so if I go long the call, it no longer has unlimited risk. And so that's a nifty thing to be able to do, is to put in a ceiling, So that would be how we would hedge a short stock position. So the answer there would have been C. What's another thing I could do to hedge a short stock position besides buying the protective call? When I say protective, I mean, we're trying to distinguish it between somebody who's buying a put and is a bear and speculating on the price going down versus somebody who's buying a put who owns the stock. By the way, very important for you as a test taker, stock always dominates. So, you know, this is a bullish position and people get hung up on that. Oh, it's a long put, I'm bearish. The stock always dominates. That's a bullish position. And the short stock is dominant. So this is a bearish position. Right? The long call, bullish. No, you're hedging with the opposite market direction. Right on. Good job. That's exactly right, Erica. The other thing you could do is place a buy stop. And it doesn't cost you anything to put in the buy stop, and you can move it around. You don't have to be approved for options. You don't have to pay a premium. But again, the disadvantage is you don't have guaranteed execution at a set price. You know, it gets triggered and then it is whatever it is in terms of execution. The advantage of the call is disadvantage is you got to pay the premium. That's the disadvantage, but you got guaranteed execution at the strike. Okay, so that's a little overview of hedging. I'll tell you what, I will link to my hedging lecture 405. I'll link to the appropriate video for that. That's actually 2 videos. I have a video on how to hedge the long stock position where I actually do the T's and I track the numbers, and I have one on the short stock. So I'll put those both at 4:05 in the live stream replay. Okay, variable annuity. So Wendy, you have variable annuities again, very big category, but let's briefly go over that. So in a variable annuity, I like that you said retirement plan, because a lot of times we refer to a variable annuity. We're at 10:28, Wendy. I think some of you guys are new to our live stream, so welcome. Erica thinks I should do this every Tuesday. I'm not going to do it next Tuesday, but maybe I'll do it the following Tuesday. I see we got some new folks. That's great. Anyways, Wendy, I'll link at 10:08 to my fabulous lecture on variable annuities. But I like that you said a retirement plan, because we refer to this as a non-qualified plan. Now, don't be intimidated by the rest of our community. But if you've been with a Series 7 guru for a while, why is the word non-qualified a pivot word for us as test takers? What does that mean for us as test takers when I say this is a non-qualified retirement plan? Anybody want to give that a shot? Very important, Wendy. What that means is we're using after-tax money. So if you give me 100
after tax, but then when you take it out, there's a tax advantage.
Yeah. Well, the tax advantage. So this is, let's say this is your deposit. Now, again, a compliance officer would be very upset with me. So don't tell me, don't tell your compliance part what I'm about to say. I think of a variable annuity, Wendy, as a mutual fund with an insurance wrapper. A mutual fund with an insurance wrapper. So it's got that mutual fund as the separate account or the sub account. And if, Wendy, you have a mutual fund in a personal account, not your 401k, but your personal account, you get taxed on the capital gains and dividends, even if you reinvest. That came up in the live stream. I don't know if some of you were in the live stream with us, but this came up about the tax consequences of the reinvestments. But in this example, in a variable annuity, that money is growing tax deferred. So let's say now, Wendy, you're 59 and a half, and there's $1 million in there. And remember, along the way, you didn't get offered the dividends or capital gains. You had to reinvest. And so very testable. It's growing tax deferred like any other retirement plan. Now, the difference, remember, if it's qualified, that means you're using pre-tax money and everything is coming out as taxable. So now you're 59 and a half. You say, hey, Dean, what's the status of my variable annuity? I say you now have $1 million in the separate account. You have accumulation units of $1 million. That's what total accumulations total. Again, accumulation units are just the insurance word for shares. So the accumulation unit every day is recalculated. It's been growing. So you can say, I want to do a random distribution. And so you say, Wendy, send me my $100,000. I say, no can do. Very testable. Variable annuities, Wendy, are LIFO. Very testable. The last monies in are the first monies out. So if I send you 100 grand, it's 100 of the 900,000 you have not paid taxes on. And all these retirement plans, when you take money out, is going to be taxed at ordinary income tax rates. When should you know that? Before or after you're 59 and a half, right? Before. I should say, hey, it's going to be taxed at ordinary income. If this was an investment and you did it outside of that, you would qualify for a long-term capital gain. So, whenever you get a tax question, guess what yields the most to the U.S. Treasury? What have you said, Dean? Send me all the money. So Wendy says, Dean, send me the entire $1 million. So what does she owe taxes on if I send her the entire $1 million? I send her $1 million. What does she owe taxes on? Oh, sorry, Cynthia. Cynthia's out in the waiting room. Sorry, Cynthia. I didn't see you out there in the waiting room. I apologize. I hope you weren't out there too long. Maybe I should put some coffee out in the waiting room for you. No answers? Nobody wants to play tonight?
Would it be 900?
Yeah, she owes ordinary income tax rates on $900,000. $900,000. Now, another neat thing about a variable annuity, Wendy, is that you can annuitize. You can annuitize. You can turn this into an income stream that you can't outlive. That's pretty cool. Right? So you say, I would like to annuitize. And that means you want to turn this into an income stream. Kind of nifty. And the insurance company, Wendy, will send you a check every month for the rest of your life. I say, do you want the insurance company, Wendy, to pay you and you only? Do you want to do life only? Because test question, if you say life only, that will give you the largest check, the largest monthly check.
But then when I pass away, the money goes away too, correct?
What's that?
So if I were to annuitize it, when I pass away, the money goes away as well,
that's
right?
right,
The
yeah.
little, okay.
Yeah, so if you go down next week in a plane crash, the insurance company wins. If you live to be 150, the insurance company loses. That's called the law of averages, the law of large numbers. So on the actuarial tables, if they're not good at the math, they won't be an insurance company long. I don't want to hurt your ladies' feelings, but I'll take a chance. I'm not going to hurt your feelings. Wendy, unfortunately, the women who choose life only at the same age are going to get a lower monthly check. Anybody want to guess about why the ladies are going to get a smaller monthly check than the men are going to get?
Because they live longer.
Yes. Isn't that fascinating? Psychologists are fascinated with that. So I've seen all kinds of studies where people try and figure out why it is that that's true on the actuarial tables. The one I like is they say that the ladies are more adaptable to changing circumstances. That, they more go with the flow when they get older, whereas the guys are, So I don't know if that's true or not, but oh well. Okay, so I send you your first check, Wendy, is $1,000. Your first check is $1,000. And I call you, I say, hey, what was your first check? You see, Dina, it was $1,000. I say, okay, so you owe taxes on 900 of that. So that's called the exclusion ratio, right? Because 90% of this is money that she's never paid taxes on. So of that check, 900 represents money that she's never paid taxes on. And 10% of that represents money that she already has paid taxes on coming back to her. So, that's how that check is going to be taxed. And then, Wendy, that check is going to go up or down based on what's called the assumed interest rate, the AIR. So let's call this your first monthly check. And let's say I'll just make up a number. The AIR is 4%. So I say, Wendy, next month your check is going to be more than 4%. More than 1,000 or 1,000 or less than 1,000. And so she calls me and says, Dean, I got my next check and it was 1,010. And she goes, woo-hoo. I go, okay, so that means we got more than 4%. So, well, how much more? I say, it doesn't matter, Wendy. I don't want to tell you because it would just confuse you. It doesn't matter if that's 4.1 or 20%. It doesn't matter. Her next check is 1,010. That means we got the year. So her check is the same. That means 4%. I find that customers never get this till the check goes down. So the check goes back to 1,000. That means we got less than 4%. So for an overtime live stream, Wendy, that's about, I think, the depth of it, but I will link to an entire, I think it's 45-minute lecture on variable annuities. But before I move on to the next thing in the chat, is there anything else you'd like to know about this?
Are annuities always non-qualified?
No, good question. Good question and very testable.
Kind of got something where it was rolling over a 401k into an annuity.
No, I don't think you'll see the rollover in 401k. But we do have a version of this called a TSA, a tax sheltered annuity, very testable. And these are for employees of 403Bs, very testable, or 501Cs. And they have what are called tax sheltered annuities, and they can actually put in pre-tax money. And that would be 403Bs, Wendy, very testable, are educational institutions. So employees of educational institutions, very testable, have a version of this where they're using pre-tax money they've never paid taxes on. If this was a TSA, that 100 grand it'd be a zero cost base. That would have been 100 grand coming out of your paycheck, like a 401k. that you've ever paid taxes. The test question is who qualifies for a TSA? And it's employees of educational institutions. Be careful, not just teachers, janitors, school nurse, not students, and employees of 501Cs. And then the follow-up test question is to know that they're using pre-tax money. It's a qualified plan, meaning they're using pre-tax money, and that means everything coming out is taxable, everything. So good question. Any other question you have on this one? That was a good one. That was a good question. That's testable, very testable. All right, so let's stick in the chat. What's next? Are KIOs testable? No. Our research reports, I'm asking, are you asking they're testable? They're testable, know that, Erica, they are retail communication. So a research report is considered retail communication because it's going more than 25 people. And you remember what I told you the test question is? That once I tell you it's retail communication, what is the test question once I've told you that that is retail communication? It has to be approved pre-distribution by a principal. It has to be approved pre-distribution by a principal. Buy a put, I don't know what you mean by that. High beta means, well, high beta just means volatility is compared to the market. So did I mention that casually? I guess it's my former options trading day. Apple, I was surprised, was at 165 because I looked at it just a little bit ago and it was like 162. So when if I said that, I'm saying it's more volatile than the underlying market. I don't know what the beta is on Apple. I could look it up, but let's say very testable, Erica. I say Apple has a beta of 2. So, I don't know what the market did today. I haven't had a chance to check. I've been, working all day long. I'm now whining officially. Anyways, so that's what I meant by high beta. So if it has a beta 2, we expect to be twice as volatile as the underlying market. And that is testable. What's the beta on an S&P 500 track fund? What is the beta on an S&P 500 track fund? Index fund 1, right? Whatever the market does, that's what it does. Okay, let's see what else. Well, there's 9 option strategies, Wendy. There's 9. There's 4 basics. There's 4 basics. There's 2 advanced option strategies, straddles and spreads. That's 6. And then there's 3 hedging. How do you hedge a stock position? So there's 9 altogether. In my playlist, I actually have that there for you, the 9 strategies. I have an entire video where I just go through the whole 9 strategies with you. And I'll link to that. That's in addition to, the other videos. I have, dozens and dozens of videos. It's starting to remind me, Erica, of my pub. I used to own a pub, and I thought it was really neat that we had, 30 beers on tap, and we had another 100 different bottles of beer. And I couldn't believe how many people would come in and they'd order like a Bud Light. I said, why would you do that when we have all these great beers? I feel like I should charge people like $20 for a Bud. But anyway, somebody was saying, oh man, that YouTube channel has so many videos. That should be a good thing, right? It's a buffet. Take what you like, leave what you don't. But I will link to that. And then I told you I'll also link to a separate lecture. I have separate lectures on each of the strategies. And then I have those 3 videos. So I will link for that. If you good, I would tell you, Wendy. So everybody is different about options. So you got to be careful. You got to be careful that you don't have too many voices in your head. So I believe in understanding contract specifications. So I think as a Series 7 test taker, if you're 65, I wouldn't worry too much about it. On SIE, I wouldn't worry too much about it. But if you're a Series 7 test taker, I would like you to be pretty good at contract specifications. And what I mean by that is you're not fumbling around when you see a short put that it's an obligation to buy the stock at the strike price. Right? By the way, Wendy, that's helpful. There's only 2 types of contracts, calls and puts. You can either buy them or sell them. So that means we have 4 basic positions. I call that the options matrix. The options matrix. And in my videos, you can watch me do that. You can make your own. And then if you can track money, whether you want to use pluses or minuses or debit or credit, I use dollars out, dollars in. If you are not fumbling around with contract specifications and you can track money, you're going to get 100 on options, right? So those are the 2 keys to understanding options. Cost-based and option strategies, Wendy's follows break even for the most part. So if I buy an Apple 165, call it 4, and I exercise, my break even's 164, and my cost base is 169. So for the most part, that follows the break evens. The exception would be a covered call and a protective put. And I would warn you that test prep vendors go way, way overboard on cost basis on options.
So what happens, Dean, if the market changes? Does the cost base or sales proceeds change?
No, if I buy an Apple 165 call and I don't exercise, it expires. That is a short-term loss. So remember, there's T. The option contract can be traded. There's no cost base other than what I paid for the option contract. It can be traded. It can be exercised. It can expire. So in my example, I buy an Apple 165 call at 4. So Erica, only one of three things can happen to an Apple 165 call. It can be traded. It can be exercised. It can be expire. So my cost base in the contract is 4. I sell it for 7. I have a $300 short-term gain. There's no stock position there. So that's just simply cost basis is when you turn your money into the investment. I turn my $400 into a 165 call. That's my cost basis. Then I turn the investment back into money, and that's called sales proceeds. So in my example, I bought the Apple 165 call at 4. I sold it at 7. Sales proceeds was 7. I net the two, $300 short-term gain. All options trading is short-term. I buy the option 165 call at 4. I sell it at 2. $200 loss. That's the T in TEE. Let me put that up here on our whiteboard. I would know there's 3 things that can happen to an option contract. So the contracts gets exercised. By the way, you should know that if at expiration, Apple's north of 165, it's going to get exercised. So now, Erica, I exercise the contract, and now my cost base in Apple is 169. If I sell Apple for more than that, right, that's my sales proceeds. The difference is what I owe taxes on. And then the option contract can expire. So if I bought the Apple 165 call and it expires, I lost $400. I have a short-term loss of $400. So it depends on what happened to the option contract about what's going to be in terms of tax consequences. I would hint time clock questions. You know, they like to say if several weeks later at expiration, you know, I would hint to you that's the only 3 things that can happen to the option contract. So I'm hinting that every time clock option question is going to end with either the contract got traded. They might say it was offset, for example, at intrinsic value, or the question is going to end with the contract got exercised or the contract expired. By the way, you should know what happened, because if it has intrinsic value, you should know it's going to get exercised. And if it has no intrinsic value, it will expire worthless. So that's what I mean by tax consequences. Let's see. I'm not sure, Gabby, what you mean by growth tax difference. What do you mean there? I'm just looking, is that a question, or are you still here, Gabby? What does that mean? I'm not sure what you're saying there.
Hi, Dean. That was an answer to one of the questions.
Oh, okay. So that, I love it when you guys
about
engage.
annuities.
So thank you, Gabby. I love when you guys engage in the chat. You know, I get frustrated when I, give you guys this time and then, people don't participate, because I said, well, gee, why should I do it if nobody's going to, participate? Gabby, 900 grand. There you go. Okay. Oh, I'm way behind. Oh my goodness. Now I see that's about that variable annuity like 20 minutes ago, right? Strangles are not tested, Erica. Strangles are not tested. What are tested are spreads and straddles, and I would know straddles with different strike prices are called combinations. All right, the basics of an underwriting spread, certainly. Okay, let me get out my little thing here. 28.59 spreads. Oh, a long day, guys. Yeah, that's pretty bad. Now, the spreads that are more often tested are munis. And so let's say that the municipality is going to receive $990 for the bonds. And let's say we're going to sell these bonds, these municipal bonds, to the public at 1,000 par. That should be the assumption you have as a test taker, that bonds in the primary market are sold at par. So test question number 1, Cynthia, is what do we call the difference between what the issuer receives, let's put that here, and the investor pays? What do we call that? That is called the spread. So warning, I'm being a jerk. What is the spread in this deal? What is the spread in this deal? What is the spread in this deal? Yeah, I got you. You guys must be new. No bond person is ever saying $10. A bond guy is going to say a point. So you're right, it's $10, but bond guys don't talk that way. A bond guy would say a point, right? It's very testable to know that a point equals $10. That's very testable. All right, so we're going to have some participants here. We have what's called the managing underwriter. So I'm going to be, I'll be Bank of America, Merrill Lynch. I'm BAML. BAML is the #1, participant in underwriting municipal bonds. And so I'm BAML, I'm the managing underwriter. It's kind of like a pyramid scheme, network marketing. You can't get the bonds without coming through the manager. And so we have what's called a syndicate. And I am the leader of the syndicate. I'm the managing underwriter. And you say, Dean, as a member of the syndicate. So let's say you're UBS, and UBS is a member of my syndicate. They say, Dean, what can we take down bonds for? I say, I will let you take down bonds for $991.25. $991.25. So, if you want these bonds, if you want to be a member of the syndicate, you want to take down bonds, you're going to pay $991.25. And so my example, Merrill Lynch, BAML, is making a little bit on every bond sold, regardless of who sells it. Regardless of who sells it. I'm actually, as BAML, I can make even more money than that, but as a minimum, as the managing underwriter, first among equals, I'm going to make that spread there, my management fee. And test question, the management fee is typically the smallest individual component of the spread. And in this example that I'm working for you, what is the management fee? Again, chance to redeem yourself. What is the management fee for BAML on every bond sold? What is the management fee for BAML on every bond sold? An eighth. $1.25. But again, remember, nobody is going to say $1.25. Now, if you're stuck on turning this into a dollar amount, you take your calculator, you take 1 divide by 8, right? And then you're going to times that by a bond point, which is $10. And you'd find out that that's $1.25. So on every bond sold, BAML's making $1.25. They might even make more than that because it's likely they're going to keep some of the bonds to sell through their own distribution network. There are 3 components of the spread, and the only participant that can capture the entire spread is the manager. Now, UBS says, Dean, we're taking down $10 million worth of bonds. So they're taking down $10 million worth of bonds. And what UBS might want to do is build its own selling group. Selling group members are not members of the syndicate. So UBS probably wants to sell some of the bonds themselves. Well, I just gave you one test question right off the bat. I just said, test question, what is typically the smallest individual component of the spread? That's a test question, and it's the management fee, right? That's fair. Now, that depends on the exam. I should clarify, this is only for people taking Series 7. If you're not taking a Series 7, you don't need to worry at all about this. So that's one test question. I'll give you some more in a minute, right? I started with a test question. What is the difference between what the investor pays and the issuer receives? That's a test question. It's the spread, right? So they're going to test you, Carol, on the components of the spread. Now, in my example with UBS, They're taking down 10 million. Maybe they want to keep 5 million and have their UBS brokers sell that. And if they want to sell the bonds themselves, they would make what's called the total takedown. Now, the total takedown is not an individual component of the spread. The total takedown is two components of the spread. But the total takedown in this example, is 7/8. So on the bonds that UBS sells itself, it would make the total takedown. And in this example, that's 7/8. And if you're not sure again what kind of money that is, you would take your calculator. You'd take 7, divide by 8 times 10, and you'd find out that that is $8.75. Now, again, testable. UBS might call Fidelity and say, hey, Fidelity, would you like to sell some bonds? Would you like to join my selling group? And Fidelity says yes. UBS says, I'll let you have the bonds for $9.95. I'll let you have the bonds for $9.95. And so Fidelity can get the bonds from syndicate members, in this case, UBS as a member of UBS's selling group, for $9.95. And if Fidelity sells those to its customers, they would make a half a point, and that's called, test question, the selling concession. The selling concession. And that's what selling groups members make for selling the bonds. Now, be careful what you're being asked on the test. Be careful what you're being asked. So if I ask what is the largest component of the spread, you would say the total takedown, the total takedown. But if I ask you what's the largest individual component of the spread, the largest individual component, that would be the selling concession, right? Because the total takedown is an individual component. So RTFQ, and this one is the smallest. Now, if you were in the live stream, this was very testable. Somebody said, well, do they ask about compensation in an underwriting? They do. And they typically ask, what would your firm make as a selling group member selling X number of bonds? So Fidelity is not a member of the syndicate. Fidelity is a member of the selling group, and they make a half a point. And remember, half a point on $10 means they make $5. And so what we did in the live stream, and this again is the test question, is they say the selling group members sold 5 million worth of bonds. And so then what we did in the live stream, and this is testable, is figure out how many bonds that is. And we say 5 million, I'm going to divide by par. Par is 1,000. So that means we sold 5,000 bonds. And then they'll ask you what was the firm's compensation, and you would take 5,000 and you times it by $5, and it would tell me that your firm made 25,000. By the way, regardless what kind of syndicate this is, selling group members are never liable for unsold securities. So whether it's divided or undivided or Eastern or Western, doesn't matter to a selling group member, because selling group members are never liable for unsold securities.
Dean,
I
can
have
you
this.
put it on the screen? Sorry, so I can take a photo after.
What's that?
Can you type that on the screen so I can take a photo?
I'm not sure what you're asking me to type on the screen. Sure, but what are you asking me to type?
The selling members are not.
Oh, okay, yeah. The other thing I would tell you is that this will be available on a replay. And then remember, the other thing is I have an entire lecture on underwriting, and then I have questions. So we got lots of stuff. So selling group members, I think that's more of like a 24 question, but you know, are not liable. In fact, Fidelity might say, or Schwab, I don't want to be a syndicate member because I don't want to be at risk. Are not liable for unsold securities. So if the syndicate blows up, you know, what does Fidelity care? And then, you know, like I say, somebody asked, what are the test questions? It's knowing the components of the spread. And then it's, you know, they might give you an exhibit, for example, and ask, you know, who are you based on this exhibit? You know, we love exhibit questions because we know the answers there. We just got to figure it out. So, you know, if I say your firm made an eighth on a bond that someone else sold, that's the manager. If I say, you know, you made a half a point and you weren't at risk for unsold securities, you would tell me selling group member, right? So they do ask you about participants in this syndicate based on this spread and how much somebody made. By the way, on the bonds that Bank of America Merrill keeps, BAML, they make the entire point, right? So if this is $100 million deal and BAML keeps 50 million, they're going to make a point on $50 million worth of bonds because they're the only one who can capture. I kind of think of it as like network marketing, right? If it's network marketing, the only one who captures the entire spread is Mary Kay. Well, Mary Kay Cosmetics, I'm joking, but I saw a Soprano episode and Tony was talking to his nephew and they were talking about the spread, the money. And Chris has said, are we going to split this with the syndicate? And he said, well, no, I don't kick down. People kick up. I do the deal myself. I'm keeping all the money. And then, his nephew said, well, if they find out, they're going to be mad. He said, well, you're the only one who knows, which I think he was kind of hinting that would be, we know where the leak is if it comes out, right? But that's the spread. Any other questions on the spread? What was the question again? Just let me see if I answered the question. I think that was you, Cynthia. Hey, Dean, can we review the basics of the spread? I think that's a pretty good job, Cynthia. I think I did a pretty good job there personally. Of course, I'm easily impressed with myself, but is there anything else, Cynthia, on this you'd want to talk about? No, does that do it for you? Should we talk about divided and non-divided?
Is Eastern Western tested?
Yeah, it could be. Divided is known as Western. When I think of Western, I think of Clint Eastwood, John Wayne, mano a mano. You tell me you're going to do something, you're going to do it. I think of divided as what goes down, stays down. And I think as undivided, I think of, known as Eastern. I think of Harvard, Yale, Princeton, Mafia. Those guys are always in it together. And so if this is $100 million deal, remember I'm asking UBS to participate in this $100 million deal. As you recall, I asked them how many bonds they want to take down. And before they really ask that or answer that, they should ask me what kind of syndicate is it. I had these very classy ladies in a principal's class, and she told me she thinks of it as a family dinner, and she thinks of it an Eastern family dinner. We just keep passing it around, but nobody gets to leave the table until the meal's all ate. Or if it's a Western family dinner, all you got to do is eat your meal, and then you get to leave the table. So let's say that this is a Western syndicate. And let's say that UBS says they're going to take down $40 million worth of bonds. So as I said, Western, what goes down stays down. So I'm the manager, I'm BAML, and I call UBS and I say, hey, I'm just checking in with everybody. I've checked in with everybody else and they've sold their bonds. How are you guys doing on your takedown of 40 million? And UBS says, we. I said, we? What, you have a mouse in your pocket? There's no we. This is a divided syndicate, my friend. You said you're going to do 40 million. You're doing 40 million. They said, well, Dean, we only did 20. I go, no, you didn't. You did 40. They go, what happened to the 20 million we didn't sell? Are they up there in bond heaven with the puppies? What happens to this deal if it's a Western syndicate and UBS said they do 40 and they only sold 20 to their customers? Where do the other $20 million worth of bonds go? Into inventory. And we say, attention brokers, blue light special. Now, if it's an Eastern syndicate, we don't care that that's 40 million. In a Eastern undivided syndicate, it's based on percentage participation. Based, again, I apologize. I do get lazy, Cynthia, and typing on the screen when it's late at night, and I've been tutoring all day long. So this is individually responsible. By the way, it's important too, because I need to do it because, there's going to be people who aren't joining us. And, so let's put that over here. And this, it's based on percentage. And so here the percentage is 40%. So let's try it again. I'm BAML, I'm checking in with everybody. And I say, listen, I'm checking in with everybody. You're my last person, UBS, to check. I've checked in, everybody's done theirs. How are you doing? You say, Dean, we only did 20. I said, oh boy, you're not going to be very popular. Because now I'm going to take the 20 million you didn't sell. I'm going to reallocate it to people based on their percentage participation. And they're going to say, who didn't get it done, right? So you're not going to be popular. Again, let's try it this way. I call you, UBS, I'm BAML. I say, how you doing? And you say, hey, Dean, we did 40 million. We said we do 40 million. We're done. I go, well, I'm sorry, but that's not true. And what do you mean? I said, well, I'm doing reallocation right now, and we've had other syndicate members that were not able to sell their bonds. As you recall, UBS, this is an Eastern undivided syndicate. And so I have some bonds for you. Okay, let's play the game. Chat is open. So I tell UBS I'm reallocating $10 million worth of bonds. So what is the reallocation to UBS based on this divided syndicate? We have UBS had a 40% commitment. I'm doing reallocation. It doesn't matter that they sold 40 million. Doesn't matter. I have 10 million that didn't get sold by other syndicate members. How much belongs to them? 4 million, right? 4 of the 10, right? Any other questions on that? All right, another one, last one. Erica, sell one ABC 50 call. Okay, so I'm selling ABC December 50 call. That is a calendar spread. That is a calendar spread. It's also known as a horizontal spread. And remember, longer term options contracts have greater premiums. And so I'm going to pay more for the December than I'm receiving for the January. I'm going to be, let me say it again, longer term options have greater premiums. So I'm going to pay more for the December than the January. So this is a debit spread. This is a debit spread. That is a debit spread you just put into the chat. Any other questions before we end the overtime session? Last call, last call.
Last one, Dean.
All right, a customer sells short 100 shares. Let me clear up my, oh boy, I'll tell you guys, work me hard. Actually, I'm not kidding. I like to listen. I'm spirit filled about it. So I don't mind. I'm spirit filled about what I do. Okay, so I'm making a T. We sell short 100 shares at 62. Let me timestamp this. This is 47.15. And I'm not going to read the rest of it. I'm just going to do it as I go through it, Erica. So, I'm not going to spend a whole lot of time on my setup, but we sell short at 62. So again, it depends on whose, process you're using. I practice the T. So, be careful, just be careful, whatever works for you, right? I had a young lady, Erica, and, I really respect her because she was so willful. I mean, just so willful. And she said, Dean, I have my own strategy. I go, well, that's great, as long as you're getting right answers. And, and then we were talking, I said, well, listen, I hate to break the news to you, but your strategy is not working. So, you need a new strategy. Now, right out of the gate, Eric, I think this is pretty foolish. If that's all I'm going to do in this question, boy, that's really not smart, because that has unlimited risk, right? So I'm short of stock. And so that's my first part. I also, Erica, like to do per share. I don't like to put 6,200 in there because I just think it's a mess. And the other reason I do that is break evens are expressed on a per share basis. So, all right. So then I sell, that's not smart. I sell an October 60 put for 6. And the reason I'm saying that's not smart, Erica, is because that's an obligation to buy the borrowed stock. I don't want an obligation to be effectively hedged. I want to have a choice. What is the maximum potential gain while both positions are in place? Wow. I don't think this must be a past perfect question. This is pretty tough. You pick out some tough ones. Now, I think, Erica, of options as being about floors and ceilings. And what we did by selling that put is we created an obligation to buy back the borrowed stock at 60. So we're not going to participate. That's why I think this is such a stupid position, right? Because you haven't hedged it properly, and now you don't participate past 60. All right, so below 60, somebody's going to exercise the put against me. And so my maximum gain is 8 points. So I just think every time I see somebody, a short stock, short put position, I go, just what a dumb bear. That's just stupid. By the way, on the test, they don't test you on being stupid. Any others? Do you see, Erica, why that's the case? There's a floor here. Let's label that.
I was just going to ask, Dean. No, I didn't see it.
So this is a floor at 60. And so, this is, now let's put that here. This is an obligation to buy the stock at 60. And I'm going to get exercised below 60. So if you didn't recognize that, This is a tough one. I wouldn't feel bad, if you missed that kind of a question. Pretty tough, pretty tough. All right, anything else? You see how I track that though, Erica? The key point is, do you see where the 62 and the 6 came from?
Yeah, I can see.
And that would be the break even, by the way. The break even here is 68. And then another way to express this is why I like the T, Erica. I always joke with you, if you start memorizing stuff, the stuff you got to memorize is just going to compound. So you could have memorized that the maximum gain is the break even 68 to the strike. That's another way to get that 8 points. However, I think you're in better stead if you can actually track the money and do the T, because then you don't need to memorize a bunch of stuff. But the maximum gain, if you're, I don't know whose materials you're using, Bass Perfect, it sounds like a Kaplan, but I can imagine a test prep vendor might explain what I just did as the break even. Let me just do that here to the strike price. Break even, which in this case is 68. And then these are challenging because remember, you're going the other way here. And so the break even, and that's the other reason I like the T, because it kind of takes you to the right direction. Right, let's just, since this is our last one, let's just do it right. The break even to the strike price. And, if you want, I don't like subtotaling, Erica, but, some people like to subtotal. What I mean by that is you want, you can net these two numbers, right? And you can say the break even is 68. And the strike price is 60 if you want to subtotal. The reason I don't like doing that, Erica, is I don't like introducing into my T, numbers that don't come from the question, right? I like to keep it, clean in terms of what I'm looking at. All right, anything else for tonight?
Will the questions look like this, Dean, or is this just past perfect?
I actually think, Erica, this is more a function of a test prep vendor question. I think the main question here, that what I certainly think is test will recognize that this has unlimited risk, that this position is not effectively hedged, right? And to recognize what would be the effective hedge, not testable, Erica, but this is called a partial hedge. It kind of works, but you really don't want a hedge that kind of works. What kind of hedge do you want? You want an effective hedge. And the effective hedge, and I think this is fair game, is to recognize that the effective hedge is to buy the call, right? So if this guy was not going to be a dumb bear, he wouldn't do this, right? He would take some of his money and he would buy like a 65 call, for example, right? And then he wouldn't have unlimited risk. That's the more likely scenario. All right, anything else? Erica's trying to talk me into doing a marathon all-night session where we just stay here, until my Zoom account says you are done.
There's no game on tonight, Dean. You can hang out.
There you go.
I'm on my way.
Okay, Mom. No, I'm okay. I'm just finishing up our live stream.
Okay,
All
bye.
right, bye. That's Mom coming back from her meeting. All right. All right, guys. I will see you for the next live stream, next office hour.
Thanks,
next
Dean.
class, whatever it is, and I'll put you, Erica, into the debt securities class. Anything else?
No,
Thank
thank you
you.
so much.
You're welcome.
Dean.
You're welcome.
Are
Thanks
great.
for
Thank
participating.
you.
All right. Remember, inch by inch, your exam's a cinch, yard by yard. Your exam is hard. Bye-bye.